Welcome back everyone, my name is Eddie and this is the Soaring Dividend YouTube channel where we discuss the dividends and other passive income investing with the intent on watching them soar. If you get anything out of this video, please leave me a giant thumbs up and consider subscribing, I greatly appreciate it. In this video we're talking about my top 3 blue chip dividend paying companies. By a blue chip dividend paying company, I mean companies that will be there well into retirement 30, 40 years down the road. Without further ado, let's get to it. Alright, the first blue chip company we're looking at today is Home Depot, ticker HD, and this is a company I always look at whenever I get some excess cash on hand. Home Depot is the leader in the home improvement industry, well beyond its closest competitor of Lowe's. Home Depot's market cap is currently sitting at about $289 billion, whereas Lowe's is sitting at $124 billion. They're both huge, big name brand companies, but Home Depot is well beyond where Lowe's is at today. Home Depot is also a huge revenue generating company, especially over the past decade, and I can see them going even further and further. We're going to look at some brief dividend metrics that really express how important of a company Home Depot is and why it's one of my favorite dividend stocks to hold. All right, let's head over to Seeking Alpha and look at Home Depot's top dividend metrics. So let's go to the search bar, enter Home Depot's ticker symbol of HD, navigate to the Dividends tab here, scroll down the page, and here's going to be a brief summary of Home Depot's dividend metrics. Home Depot has a dividend yield of 2.48%, and I consider this relatively average. A smaller dividend yield for me is about 1 to 2%, and then on the higher end is anything above like a 4.5%. Home Depot also has a very nice payout ratio of about 52% right now, which means that they're significantly growing as they pay back their shareholders a portion of their net income. The best metric to look at here, in my opinion, is the 5-year dividend growth rate, or the 5-year dividend CAGR, which is hovering at about 20% right now. This basically means that the company is increasing their dividends year to year at about a 20% rate over the 5-year period. So it's a 5-year average of 20% year over year, which is fantastic. And if you go up a little bit to the dividend history section right here, this is going to show how much their dividend payout has increased year to year. And right now in 2020, their dividend payout is 1.5, so $1.50. And they just released a new dividend of 1.65, so a 15-cent increase from their previous period. And this is part of the calculation of that 20% dividend CAGR. All right, the next thing we're going to look at is some brief financials for Home Depot. We're going to be looking at gross profit, cash flow, and total debts. So let's hover over to the financials section here. We're going to be looking at gross profit really quick, just to get a grasp of where the company is at. So if you go to the income statement, gross profit is right here. And if you look from February 2020 to January 2020, their gross profit has increased about $7 billion since then. So this is a huge gross profit increase from that period to this period. All right, the next thing we're going to be looking at is cash flow, which is king for a dividend company. We're going to be looking at 3 different types of cash flow today. So the first cash flow, let's go into the cash flow statement right here. So the first type of cash flow is the cash flow from operating activities. Let's just scroll down to the totals, which is the cash from operations. If you see, this is the January 2017 value, which is $9.7 billion. And from 2017 to 2021, you see almost a double in their cash flow from operating activities, which operating activities basically covers their in-store operations. So that's exactly what we want to see for this company. The second type of cash flow is the cash flow from investing activities. And you see this is a big jump from negative $2.6 billion to negative $10 billion. This negative cash flow is likely due to the purchase of some long-term investments, which have the potential to generate future profits. So this is a fine number to see here. And then lastly, we have cash flow from financing activities. So let's go down to the cash from financing total right here. If you go from January 2017 to January 2021, you see a nice decline here. And this is a indicator that means that the company continues to buy back shares from investors, which leads to higher dividend payments for them in the future. All right, this is macrotrends.net, and this is just going to be a quick overview of their shares outstanding. So just type in Home Depot's ticker symbol up here. You go to the revenues and profits, go to their shares outstanding. As you see here, company continues to buy back shares over time, which thus increases the dividend payouts for us as shareholders. This is the exact downward trend that we want to see as investors, so we get the most optimized return. All right, the last thing we're going to talk about really quick is the debt of the company. So we can go to the balance sheet. We're going to scroll down all the way to the bottom until we get to total debt right here. January 2017, there's a $23 billion debt. And then in January 2021, you see a $43 billion debt. So you obviously see a huge increase in the debt over time, but I believe that Home Depot can slowly chip away at their long-term debt as they are generating significant amounts of cash, as we previously saw. This is something to monitor in the long run, though, and make sure that you are aware of the possible risk associated with increasing debt over time. I hope you enjoyed my brief analysis of Home Depot. And just to let you know, I am not a financial advisor, and this is for entertainment purposes only. I do this just for fun and because I have a passion for finances. Please do your own research whenever you invest in a company, and always stay vigilant. The second blue chip dividend paying company I'll be talking about is Johnson & Johnson, ticker J&J. J&J is one of the world's largest and industry-leading healthcare companies. They have a wide range of extremely successful products such as Tylenol, Neutrogena, Listerine, and so much more. I believe these products will last lifetimes and aren't going anywhere anytime soon. In addition to their commercial products, J&J also just released a vaccine for the COVID-19 pandemic and is very motivated to making the world a safer and healthier place to live in for generations to come, which is why I am extremely bullish for J&J in the long term. Let's head over to Seeking Alpha and take a look at Johnson & Johnson's best dividend metrics. So let's go to seekingalpha.com, type J&J at the top, go down to the dividends tab again, go to the dividend summary section. Johnson & Johnson has a 2.5% dividend yield, which is a small to average one in my opinion and is safer. They also have a 42.46% payout ratio, which is relatively small, and I can see that definitely growing in the long run. They also have a 5-year growth rate of 6.13%, which is relatively average. And one of their best features and one of their best accomplishments is their dividend growth of 58 consecutive years of continuous payment increases, which is a huge accomplishment for any company to have, which makes them a dividend king. And I can see them going well into the future, making that 100-year mark well down the road. And I hopefully will see that into retirement. So I am very excited and bullish on J&J, as I think they can go further and further. Let's head over to the cash flow statement and take a deeper look at their finances really quick. All right, let's take a quick look at Johnson & Johnson's cash flow statement. So go to the Financials tab, click on the Cash Flows button. We're going to scroll down the page until we hit the cash flow from operating activities right here. Let's go down to the total cash from operations, which this includes store operations, so your day-to-day purchases at a local Walmart, for instance, when you buy some Tylenol. So as you see, it goes from $18.767 billion in January 2017 all the way to $23.536 billion in January of 2021. So an excellent cash from operations increase steadily over time, which is fantastic to see, especially during a COVID pandemic right now. All right, let's look at one more cash flow item really quick, and that is the free cash flow per share. This is an excellent item to look at for a company as it does not show the company's deflated cash flow. So what I mean by that is it's usually a better indicator of financial fortitude since it keeps their cash flow from being artificially deflated. Companies do this to attract new investors at a quicker rate to show that they are generating a significant amount of cash to keep their dividends stable over time. So as you see, Johnson & Johnson has steadily increased their free cash flow per share over time, which is exactly what we want to see as investors. The last thing we're going to look at right now is the gross profits. So let's scroll down here. Gross profit over time has also steadily increased to January 2021, which is $54.257 billion. This has been consistent and it's a great sign. And last but not least is the total debt. I always like to look at debt really quick just to make sure that the company is not too far in it and can't get out of it. So here we go. Let's go to the total debt. So in January 2017, it hit $27.5 billion, and now it's up to $36.366 billion. So you do see an increase in debt here, which you have to be careful about. But I think that J&J is doing well with paying off their debt until the pandemic hit. Hopefully the company can decrease the debt as the economy improves post-vaccine rollout. And as you saw earlier, they're still generating a significant amount of cash to hopefully pay down their debt in the future. The third and final blue chip paying company that I'll be talking about today is PepsiCo, or PEP. Pepsi is my favorite consumer defensive stock right now because of their success in the food and beverage space, their scalability and even more important product diversity, and their executive's mission to reward shareholders in the future. This is one of the most powerful companies right there in the market today and one of the most underrated companies in the market today. People mainly look at Coca-Cola as the leader in the drink space, which they are currently the leader in the drink space. But Pepsi has brands ranging from Cheetos all the way to Lipton iced tea. So that is why Pepsi, in my opinion, is a stronger stock just based on their awesome product diversity. All right, let's look at the last stock's dividend metrics. So let's go to PEP, go down to the dividends tab. They have a nice 3% yield, which any yield above a 3% is usually a definite buy for me, as long as I see the company there long down the road. They also have a great 5-year dividend CAGR of about 7.8%. And this is why I love Pepsi over Coke, is because Pepsi is a huge dividend grower. They're a grower, not just a shower, all right? And finally, they have a dividend growth of 48 years. This is almost making them a dividend king. They're just there, all right? They're almost there. They're going to get there very soon. Let's go ahead over to a quick analysis of Pepsi's shares outstanding. For a nice cherry on top, PepsiCo's shares outstanding is steadily decreasing over time, which this is exactly what we want to see as investors, because as the shares outstanding decreases, we get rewarded more and more, so higher dividend payouts long down the road. PepsiCo is a leader in the space and is a huge dividend machine. I strongly believe that, which is why I'm extremely bullish on them and see them well into my retirement. All right, let's take a quick look at PepsiCo's finances. So let's head to their income statement here. Let's go to their gross profit. Their gross profit in December 2016 is at $34.5 billion and has had a nice $3 billion increase in December 2020 to $38.6 billion. This is exactly what we want to see as investors, a steady gross profit increase over time. Next up is the cash flow statement. Let's scroll down until we get to the net change in cash right here. This net change in cash has been fluctuating year to year for 3 years. And then once December 2019 hit, they had a big decline. But we see a nice spike back of $2.6 billion, which shows that the company continues to generate cash flow during a difficult pandemic. So again, what we want to see as an investor is this. However, we want to be wary of it long down the road to make sure this doesn't continue to go negative. Lastly, we're going to look at total debt. So let's head over to the balance sheet. Go down to the total debt section of PepsiCo's statements right here. And the biggest downside of PepsiCo is their debt, in my opinion. I am willing to look past this one negative based on all their other positives, but still something to keep an eye on long down the road. And I will continue to monitor this every couple months. So as you see here, it's a $45 billion debt versus the previous year at $33 billion. So keep monitoring it and stay safe.